Hi everyone, and today on this quick take we'll look at Xero Limited, which is on the Australian Stock Exchange. So what it is, it's a software company that's specializing in accounting software. So now let's have a look at its financial before we jump into the stock price, because depending on what kind of style investing you're doing, are you a trader or investor? If you're a trader, you can probably jump straight into the graphs and have a look there, but the chart and have a look. But I'm more of an investor. I do a little bit of trading, but not as much as having a look at good company and holding it for a longer kind of period between 2 to 5 years. All right, so let's have a look at this company. So Xero, current ratio 8, fantastic, but doesn't have a quick ratio. So let's open this side up and let's have a look. There's nothing there, that's fine. Let's go to ASX. Quick ratio, no, nothing. All right, normally I use my another platform, but because there's an agreement there, that's now I can't actually use it to do these kind of things, so I have to use more freeware. So anyways, it doesn't really matter, we can work it out. All right, cash flows. Cash flow from the graphs, that looks okay. So what do we, cash, net change in cash. So net change is negative, so less. We just do it. So yeah. Oh boy, that's really annoying. Anyway, so cash flow is looking really good. So we want to have a look at how this happened here. So 2020 cash flow from operation gone up, fantastic. If investing gone, yeah, it's investing. Cash flow from investing activities when they spend money to invest in maybe new equipment, new software, and stuff like that. So financing, that's probably why that peak in net change in cash. So they're borrowing a fair bit of money here. So, or they're issuing shares and stuff like that. So that's huge. Maybe they want to develop improve their software, so we want to find out there also. But financing, so they're paying back debt here, which is always a good thing. So net change in cash, negative net change in cash, then does not necessarily mean a bad thing. You want to know the components to the net change in cash. So they're investing a lot of money and they're paying back debts. That's why you get a negative net change in cash, which is fine. But you can see, so that's where you want to have a look at the quick ratio, but the quick ratio is not really there. So what we can have a look at is the this financial summary, the balance sheet, just to have a look how much cash they have on hand. While that is loading, all right, very poor internet in Australia. Anyways, balance sheet, let's go straight to cash. Yes, so much cash, look at that, 222 million. Oh wait, that's quarterly. All right, let's have a look at that. 108 million, so that's a significant amount of cash. So let's take that 108 and let's see the current liabilities. Total assets. Nah, I don't need to look at the total asset. Just want to have a look at cash equivalents, short-term investments, receivable. I mainly want to look at cash and divide that through by the total short-term liabilities, because that's, cash is what's going to pay the bills. So creditors, banks, interest from banks and stuff like that. So let's have a look. Liabilities, long-term, current. All right, total, other current, total 21. So yeah, that's a significant amount of cash. So what it's saying here to me is that it will definitely last this year. with the amount of cash it had, but keeping in mind that it did borrow a whole chunk of money in 2019. Right, so it's looking good so far. So let's have the cash flow again. And all right. Cash from so capital expenditures, financing. Excuse me. What are we looking at? Again, annual should be, anyways, the default for me, anyways. Cash receipts, cash from investing. So this is how much they received. Cash from investing, capital expenditures, financing. It's good. Issuance, debt, net. Okay, yeah, that's where. So they borrowed some money. And you see there, issuance, retirement of debt. Yep. Anyways, free cash flow. Okay, doesn't look too bad. All right, let's have a look at ratios. Really, I always jump into the ratios first. P ratio, wow, 622. That's huge. That's like you gotta put in $622 just to get $1 back from them. Not a good thing. Price to sale. Let's have a look. What are we looking at? Net profit. Quick ratio. Quick ratio. Doesn't have one. There you go. Odd. Anyways. Yeah, so this is current ratio. Okay, so what's putting me off this company is this huge PE ratio. Now, the optimal is around 10 to 15. But negative does not mean you want it lower, but negative means that something is wrong. Negative is not a good thing because P ratio is the price divided by its earning. So the price can never be negative, right? Because otherwise it will hit zero and nobody wants to buy. It can't be like the price can't be negative because the company wouldn't pay investors to have shares. It's almost like a useless company, and it means it's bleeding money. So the two parts to that equation is price and earning. That means earning has to be negative. That means it's not making money. Anyways, sidetracked. Yeah, it's fine. It's not negative, but it's really high. Where are we? P ratio, very high. Higher than industry too. All right. It doesn't pay dividends. I know that. Just while it's loading, let's have a look at which industry. So this one here, yeah, it would be a software company. It doesn't say where it is. I don't usually look at ASX, and this is a new website too. It looks really nice actually. Price to free cash flow, PE 640. Yep, we saw that before. Okay, so no dividends. Let's have a look at earnings. Earnings. It's so slow. No, forget it. Revenue is nothing there. Alright, don't worry about that. Income statements. So at the moment, I'm still quite interested in it just because I know it's been performing well from the cash flow and the cash flow. So it got really good cash flow. All right, so total revenue's been going up, very good. But let's have gross profit 611. That's good. Let's see, and you minus all of that. Net income is 3 million. Well, it's definitely not losing money anymore, so that's always a good sign. So with these kind of tech companies, they lose money for the first 2 to 5 years, could up to 7 years. and when it's making money, it can, because these software companies, they need a lot of money to get themselves settled and start to penetrate the market. And once that's happened, they got a good steady user base, then it's the money comes in much quicker, because it doesn't take a lot of effort, it doesn't take a lot of overhead to scale when you have a software company. On the other hand, in contrast, let's say if you have a mining company, then there's a lot more overhead. You gotta invest in equipment, invest in personnel, and legislation around mining and all of that. So that's why there's always this buzz about software companies. Anyways, moving on. So that's a good sign. So it could be in its early growth stage or moving towards that rapid growth. So quite interested in this company. So let's have a look at the charts. Let's open up the fully featured chart. Let's see if we missed anything. Obviously, you want to do a little bit more reading into the company, know what it's all about, know where the investment company in. But in these quick take videos, what we want to do is just, let's say you're under pressure to buy whatever the reason is, FOMO, or you know, mainly it's FOMO really, or so a friend asks you, can you just quickly analyze this for me and give you a take, and you're not very interested in the company, and but you want to do the best job you can with the time and enthusiasm you have. So this is what I do. Okay, the graph looks fantastic. In terms of, if I bought down there in, let's see, what's the pandemic started here, yeah, 57, now would have, 300%. All right, 3 times, sorry, so 200%. All right, so firstly, this kind of graphs is exciting, but it scares me. It just means that there's possibility of a hype here and there. So right off the bat, I'm kind of like, well, I'm not going to be investing a lot of money at the moment, because one, if it is truly in its rapid growth phase, then investing a little bit of money can give you a great return already. So you don't have to put in a lot in these kind of like, when you catch it at the rapid growth phase. Second, when it's like this kind of graph, you kind of have to wonder like, is it being hyped up? So a pump and dump scheme. What that means is that if you put in too much here, there's a lot more risk if it falls down. But if it does fall down and you only put in a small amount, there's always chances for you to buy it. And if it doesn't go back up, then you only lose a small amount of money. So this is where we have to lay out a plan and be really disciplined about it. So I guess this is as far as this graph will go. Don't really want to look at the hour. I want to just look at the whole. Let's look at the day. With stock, I do a bigger time frame. All right, so it seems like it started in 2013. Is that correct? Somewhere here it will say listed 2012. All right, towards November 2012. Yeah, look at that graph. Scary. So when you see this, is you kind of always buy it. So hindsight is always 2020, but it's hard to predict how it will go up this way. So if you that's why when I look for companies, I look for somewhere like it's a little bit flatter, but a little bit more. So then you can catch a lot more. There's more upside for you. $17, so you make 10 times that in 3 years. It's not bad, is it? Anyways, looking at this, there's no resistance, because this is the highest it's ever been. But the next kind of support is probably at 88. Could be at 58, could be at 51, could be at 35, 42, and the lowest 11. So popular tool that people use is the Fibonacci's retracement. So let's just have a look. Let's see where it will retrace to. All right. Okay, so I don't think if it does retrace, it may go down to this level. Yeah, it's a difficult one to have a look at when you have a look at these companies. I don't think it'll go down here. What I reckon is it's heading towards here at the 78% mark, which is $121 per share. So if FOMO kicks in, we can buy here at the minimum your broker will allow you to buy. And when it gets down here, you can probably buy the minimum again. Here, you can double your minimum at the $96 mark. So yes, so that's the game plan here. So minimum here, if FOMO sets in, minimum again, double your minimum, and I don't think it'll drop down to here unless it's a terrible company, but I don't think so. So for me, I will be waiting for this one. I wouldn't jump straight in. Let's put in some indicators. Let's go. I don't want simple. I usually use exponential, moving average exponential. Put 2 of those up. 9 close. Let's do I do 31, and I usually do close, and I'll press OK. And I'll do a longer period, 120, 3 months. Let's have a look. It's a terrible color, can't see anything. Style, red. Okay, all right, that's a little bit better. Maybe yellow. All right, Lisa. Yeah. Okay. So what it's saying here, yeah, I don't think it's a good time to buy. It just seems like it's turning point here. So I would let this one cross down and then cross back up. So it seems like it might cross around the 120 mark. So where our Fibonacci retracement is showing. It's not a bad thing. Right. What I want is, let's see, a MACD. Oof. MACD. Just a... So the MACD is telling me that, yeah, it's probably a sell around there, which what it looks like too. So what I would do is wait for the MACD to show otherwise. So conclusion for this company, it's okay. P ratio is a little high, but it's starting to make money, so it could be in a rapid growth phase, or at least the first growth phase is over, or the first growth phase is kind of, you're already in it. So the graph is telling me that there's a lot of downside to buying now, so I would wait a week or two before making any purchases.